we were in negotiations.
Investing in real estate, they're winning, they're making money.
Hey everyone, welcome to the Real Estate Educators Podcast, where we provide the education you could build on. I am your host, Kevin Amolsh. Here we are, our first true solo episode of the Real Estate Educators Podcast. If you like what you hear, please give us a 5-star review. Share this with a friend. We're trying to build a bigger and better community to help more real estate investors just like you. So for this episode, the solo episode, I'm going to go through a little slideshow here. And I know there's a lot of you out there that are just listening in the car. So I'm going to do the very best I can to describe exactly what's on the slides. And if you want to, please go back to our YouTube channel and check out the video so you can see the slides if you need to. The YouTube channel, of course, is youtube.com/Pine Financial. That's where you'll find all of the videos for the Pine Financial videos and the Real Estate Educators Podcasts recordings. So this one, we're going to talk about becoming a millionaire with real estate investing. And I know this is a really popular topic because we all want to become millionaires. So what does it take to be a millionaire in real estate? And why is real estate such an effective way to get there? So first of all, what I want to do is define what a millionaire is. And I know this sounds very obvious, but it's maybe not as obvious for everybody. So for those of you out there that are unclear, millionaire status is just taking all of your assets and subtracting your liabilities. So there's some controversy in this when you start looking at some of the experts out there, like Robert Kiyosaki, for example. Now, I'm a huge Robert Kiyosaki fan. I learned an absolute ton from him, and I'm not necessarily disagreeing with everything he says. But when you're looking at net worth from typical, through a typical lens or through the lens of a banker or a lender, they're going to be looking at total assets minus total liabilities. Robert Kiyosaki, of course, doesn't believe in that. He believes that if there's an asset that's taking from you, like your home, for example, you got to pay your taxes, insurance, your mortgage. That's a liability and not an asset on your balance sheet. But in the real world, in the banking world and the lending world, it is not viewed that way. Your house is an asset. You could sell it and you could generate cash from it. So we're gonna use the more traditional net worth definition here. So total assets minus total liabilities. That'll include your home, your cars, any other real estate, jewelry, personal property, furniture, all of that, minus any debt that you have against that. I shouldn't mention this. So many people, including myself, when they're just kind of getting started in real estate, they think this millionaire status is some like elusive thing, very, very difficult to get, something that you should be striving for. And I don't disagree with that, but $1 million isn't what it once was. I think you'll learn this as you move through your career, but a millionaire isn't all that important. You're probably going to want to be shooting a little bit higher than that for a net worth goal. But we're just going to stick with the millionaire status for this. And I'm going to go through why I believe real estate is the best investment to get you to that status. Okay, so there's mainly one reason for it. And it's real estate has 4 different ways to generate net worth for you. Net worth, increasing your assets or reducing your liability. So number one, the biggest one, the reason I am so attracted to real estate and why I own a portfolio of properties and why I'm consistently buying, and it's cash flow. So this is money that is going into your bank, and a net cash flow would be total net after all expenses. So typically liabilities come with an expense, which is like a monthly payment on your mortgage, for example. So you calculate all of your income that you get from your rental properties, subtract the vacancies, the maintenance, your mortgage payments, your taxes, your insurance, all of those expenses. Whatever is left over is your net cash flow. Obviously, we want that to be positive, but positive cash flow is wealth generator number 1, and that's why we love real estate. Number 2, and this is the big one, this one is the one that's really going to make you wealthy, and that's appreciation. Now, I'm not necessarily saying that you're going to just rely on appreciation to become rich in real estate, but it is a big factor. Over time, real estate does tend to go up in value, and the reason for that is it's finite. meaning it is limited. So although there'll be corrections in the market, markets do breathe, they go up and down. They typically over time will go up because it is limited. And inflation, since we've just got through a pretty high inflationary period, is a perfect example. As inflation goes up, finite assets go up in value. That's why people invest in gold, for example, as an inflation hedge. As the value of the dollar goes down, assets go up. That's another reason why we like real assets and specifically real estate. But I'm going to show you some examples here on why appreciation and how appreciation is so powerful in real estate, and why, it's my opinion, it's 1,000 times better than investing in the stock market. I know that's controversy, so leave me a comment on why I'm wrong there if you'd like. Number 3 here in the 4 wealth generators is the loan pay down. So how about this? How about I buy a piece of property, I rent it out for cash flow, I get the benefit of the monthly income, I get the benefit of it going up in value over time, and by the way, my tenant is paying off my mortgage for me. So that's what loan pay down is. Every single month, when that mortgage payment is made, a portion of that goes into interest, a large portion in some cases, and a portion of that goes to interest. And over time, it's like a reverse compound effect or a negative compound effect. It will go down. Your loan balance will go down exponentially, meaning each month more and more and more of your monthly payment is going towards that principal, just plowing into that debt and eliminating that. And there's some strategy here when you start to understand this. If you can still have positive cash flow or handle maybe a small negative cash flow and decide to go with a shorter amortization schedule, like maybe a 15-year loan instead of a 30-year loan, you will see tremendous benefit in this wealth generator because your loan will be paying it down very, very quickly on those shorter amortization schedules. And then the final one here is the tax benefits. Now, this is a difficult one to really measure because, well, let's just talk about it. The big tax benefit, there's a lot of them that are more creative, like maybe you're traveling across the country and you have some properties you're going to go see, but then you also visit your family or your friends while you're in town. But you flew into town to visit some properties. Well, that trip is deductible. The flights will be, the hotel will be, rental car will be. The only part of that trip that won't be deductible is anything that you're doing for personal use. So if you go to a concert, for example, with your friend, you would probably not deduct that. But the flights and the hotels and everything, all of that would be deductible. And that's one of the big benefits of being a real estate investor. And that's some of the more creative ways. Now, outside of that, the big one that you hear about and that most people talk about when it comes to the tax benefits for real estate is called depreciation. So we just talked about appreciation, and that's the home going up in value. Depreciation means it's going down in value. So the way this works is the IRS assumes a useful life for real estate. So let's call it, and I know in commercial it's 39 and a half years. So over the 39 and a half years, your value of that building will be going down in equal increments over that period till it becomes a zero value. And so every year, whatever value is lost in the view of the IRS will be deductible on your tax returns. It'll be deductible as an expense, basically. It's a depreciation expense. Now, we call that a phantom loss or a phantom deduction because it's not actually coming out of your pocket, but it is showing up on your tax return and it is reducing your tax liability each and every year. Huge benefits to owning real estate. Now, I say it's a tricky one. It's a tricky wealth generator because although the depreciation is super powerful and it gives you value immediately today, right now, when you sell that property, you have to recapture that unless you're doing some type of 1031 exchange or something like that. But in general, when you sell rental properties, you recapture any depreciation that you've taken over the years and you pay tax at that time. So that is true. So you get a benefit now and then you repay it later. But if you look at the time value of money, the money is more valuable to you now than it is in the future. So you want to maximize depreciation to get the biggest benefit for you today. And think about it. If I take a deduction today and I get to keep more money in my pocket because I'm paying less taxes. Well, I could take that money that I'm saving now and invest it, right? And then I could continue to build towards my net worth, my millionaire status with that extra money. So it is good to maximize your depreciation event benefit. Okay, wealth generators, 4 of them. Being a real estate investor, and this is how you become a millionaire. You have cash flow, you have appreciation, you have loan to pay down, and finally you have tax benefits. So I'm just putting up a slide here for those of you that cannot see, and I'm showing a return on investment, ROI. Now, when you can maximize ROI, this accelerates your chances of millionaire status. So we want to shoot for investments that have high ROIs. So an ROI is calculated by your total return divided by your investment. And you hear like stock market returns 10 to 12%. Those are straight ROI, very simple. You get a return and you made your whatever you made your investment in. There's no leverage, there's no tax benefits, there's no all this other stuff that real estate has going for it. Stocks do not. So it's very simple. In real estate, a total return is going to account for all the cash flow, all of the appreciation of the home, and the principal reduction of your tenant paying off your house. Now, some people will even include the depreciation tax benefit in total return. I'm choosing not to because you will have to pay that back at some point, unless, of course, you hold the property until you die, in which case it would go to your heirs and there would be a basis step up, which is way more complicated than I want to cover in this podcast episode. But just know that whatever depreciation you took in your lifetime, if that passes to your kids, as of today, they will not have to pay tax on that. There is no recapture on depreciation on assets that are transferred through an estate. Okay, so I'm only using 3: cash flow, appreciation, and principal reduction. And I'm going to use an example here to go through how powerful this is. And I'm just taking a very simple $250,000 house with a 4% appreciation, which is about half of the long-term average. Okay, so I'm trying to be very conservative in my estimation here, knowing that it goes up and down. So I'm taking a 4%, which again is close to half of your long-term appreciation rate across the country. I'm going to put a $50,000 down payment. So very, very bread and butter, basic deal here. We're not getting creative with owner financing. We're not getting creative with the Burr strategy where you're using hard money to eliminate or limit your down payment. It's just a very standard bank financing type of deal. 7% interest rate. It's probably a little bit higher than that right now. So I'm not necessarily being ultra conservative. Maybe I should have done that before I put the slide together. But 7% interest rate was not long ago. That's about what it would be. I think for owner occupieds, as I'm recording this today, it's in the high 6s. So you're probably mid 7s, a little higher than that maybe on investment properties. Okay, so here's how we calculate it. ROI, I'm going to say a cash flow of $6,000. Because I'm putting this big down payment, 50 grand, I should be shooting for and targeting properties that will produce cash flow. So in this example, I'm going to say it's a $500 per month positive cash flow. I think you should be able to get that on a $250,000 house with a big down payment. Appreciation at 4% is going to give you $10,000 in year number 1. Okay, so $10,000 increase in property value year number 1. Principal reduction at that 7%. I'm rounding here. It's a little higher than this. I'm saying it's about $2,000 is going towards principal, which is very low, right? As interest rates go down and you refinance or you buy properties with lower interest rates, you would see that principal reduction number significantly higher than that. Total, and obviously the cash flow would be higher as well with a lower mortgage payment. So total income or total return on that year number 1, $18,500 divided by my $50,000 investment, and I have a return of 36% annual return on investment. And that is not including any rent increases over time and the compound effect of appreciation and the principal reduction. So we're only looking at year number 1. Every year after that, you would expect your returns to go higher and higher and higher. And I wanted to show this slide here. What I'm looking at is a combination of home appreciation, what the value is over time at a 4% compound, and what the amortization schedule will show you for paying off the loan at a 7% interest rate over 30 years. Okay, so you can see at the very beginning, for those of you that are looking at it, for those of you that are not, year number one, you have about a $50,000 equity spread. And that is right, because that was your down payment, right? So you should have $50,000 in equity. Over time, that spread, this is how you become a millionaire. This right here, the slide I'm showing you, this is the secret to real estate. You have the value going up while you have your loan going down, and it's exponential. So the spread is further and further apart every single month. And I just put one more slide up here. This is the equity. So all I'm doing is taking the difference between the value and the debt, and I'm looking at that over time. And you could see that on this one little house, all we're looking at is one house over time, the 30 years that you would have your mortgage, you're going to have about $800,000 in equity on this one house. That's not counting the cash flow. Okay, so one house could get you very, very close to being a millionaire. Now I said, oh my gosh, Kevin, that's going to take you 30 years to become a millionaire. Well, think about this. If you look at year number 10, you're about $200,000 in equity on one house. So the way my mind works is, well, how many houses do I need to get to millionaire status? Well, you're going to have to buy 5 houses in that case with this strategy, very simple strategy. I could tell you with real estate, one of the other reasons I love this so much more than stocks is I could force appreciation. I could buy a property that is in need of repair, add value by remodeling it, and then I'll have more equity than the $50,000 on day one. So it's finding great deals, forcing appreciation with rehab, renting it out, and keeping it for the long term. That's the secret, guys. So here's some concerns that I hear. Well, I don't know if real estate's going to really get me to the millionaire status. What about the down payments? There's $50,000 for one house. I mean, I'm really going to be limited on how many houses I could buy. Yes, I get it. You're absolutely right. That's why I'm saying maybe use income from other sources like fixing and flipping. If you're a fix and flipper, maybe save one fix and flip instead of pocketing that money. You take that and you invest that in a down payment and buy a house. Maybe do that once a year and see what happens. But other ways you could do this, house hacking. This would be someone buying a property, renting out a room, renting out an extra an extra unit, an accessory dwelling unit, anything like that, that you could produce income on that property while you're living there. And then you get it into a position you want to move out, move into another one. Do that every couple of years and watch how your wealth grows. Number 2 I put up here was BRRRR, buy, rehab, rent, refinance, and then repeat. Buy, rehab, what I just mentioned on the value add, rent, and then refinance it, get your money out, and then repeat that over and over and over. And according to my slides that I just showed you with very average deals, it's only going to take you 5 properties if you're willing to wait the 10 years. And think about it, most people will work for 20 or 30 years and not hit millionaire status. I just showed you a way you could do that in a fraction of the time. And not including your retirement money that you're investing in, all the other things you have going on. This is just buying 5 little houses here. Owner carries. I think a lot of you know, if you heard my stories, I was buying 1 or 2 properties every single month, no money down. And I was doing that because of owner carry. Also partnerships. I would bring in partners for down payment help and to sign on debt because of the credit. They have great credit, so we can get better, more attractive financing. They could qualify for loans, which I couldn't do when I was going through some financial troubles back in 2008. So partners are fantastic. And then, as mentioned, fixing and flipping does work. It always will work, and it'll generate large amounts of cash that you could use for those down payments. Your concern might be, well, is a deal even worth buying? How do I know this is a deal that's going to get me to my goal? Well, we have people like Pine Financial Group that do this in and day out. We understand this business really well. All of our loan officers have fixed and flips, own rental properties. We understand what it takes to be successful, and we want to help you. We truly want to help. Do we make money because of it? Of course. But I'll tell you what, if you're out there, if we're out there making millionaires, You're going to tell other people, you're going to come back over and over and over. And I got to tell you one thing, when you help someone become a millionaire, it feels pretty damn good. So let us help you reach your goals. Is the deal worth buying? I don't know. Give us a call. We'll help you through that. Should not be a concern. What about the management headaches? Now this one, maybe this one is an actual concern, because even I have properties that I manage myself with my wife, and I have properties that we don't manage ourselves. We have professional management in place. And I got to tell you, there's not much difference. I mean, sometimes managing a manager is very difficult. So this one could truly be a concern, but this is one of those things like, are you willing to put in the effort to reach your goals? And if you want to be a millionaire, it will take effort. So let's get past that concern about management headaches. Bite the bullet, because owning real estate is fabulous investment and it will reach your millionaire status. Another one, unexpected expenses. Yeah, this is legitimate, guys. Vacancies, damage to the properties, especially if you're down south or on the southeast where you have hurricanes. I know this has been a big problem. Is we've seen lots of damage to properties. So you just have to manage through this. Do you have the liquidity, the liquid reserves to manage through vacancies and damage and get to the other side? Sometimes your cash flow will take a hit when you have these problems, but as long as you're prepared for them and you have the long-term strategy, it's going to work 100% of the time. I don't know any investment out there that is guaranteed to make you a millionaire outside of real estate. And then finally, what if the market tanks? Well, we went through that in 2008. So here's my thought on that. You could get hurt owning real estate, but you can get hurt owning any asset. The stock market took a tank also. So no, I don't care what you were invested in when the market was collapsing, you were taking a bath. Here's the advantage. When you see that and you're in and you see the values of the properties going down, that is a buying opportunity. Does it suck for the properties that you have right now? Yes. Does it create some amazing opportunities to grow your wealth? Yes. More millionaires are made in down markets than up markets. I promise you that's true. So don't worry about the market tanking. Maybe you want that, but I don't think you wait for that, because I know people that have been waiting for that since 2008. Right. And we went through COVID where we all expected that's going to trigger the recession, that the value depreciation is coming, and it still didn't. In fact, it went double digits in appreciation during that time. We saw some markets appreciating nearly 20%. So if you're waiting for the market to tank, look what you missed out on. I would not try to time the market. Invest for the long term and become a millionaire. I hope you enjoyed this episode. It's my first solo, I guess all solo, except for the little intros and outros that we've done for each season. So this is a true podcast episode, my first solo one I've done. I hope it's been valuable to you. If you're listening and you want to go check out the slides, youtube.com/Pine Financial. Otherwise, thank you so much for checking this out. I know you have lots of different podcast options out there, and you chose to tune into the Real Estate Educators podcast, and I'm so appreciative of that. I'd be more appreciative if you gave us a 5-star review, share it with a friend. Let us know what we could do to help you on your journey to millionaire status. And with that, I hope you make this day a great one. Thanks. Hey guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh yeah, and tell a friend.